Welcome back to Higher Exchanges. It's a special day, and I am your host, Jesse Redmond, Head of Investor Relations and Business Development at Leaf Brands. I'm joined this week and every week by Morgan Paxia. He's the co-founder of one of the last standing cannabis investment firms that's called Poseidon. Morgan, the survivor, how are you?
Surviving, baby. But this is great. We're here on video for the first time ever.
I know it is very exciting, and I just clicked over to X to make sure we were streaming live. But let's bring in the special guest before we get too long because everyone can see his face. And he is here for version 3.0 of Higher Exchanges. He's Sammy J on X. He's Sam Armenia in real life. He's VP of Corporate Development at C21 Investments. Sammy, good to see you, man.
Thanks for having me, guys. Thanks for letting me be the first up on the revamp, especially after Scott was unbelievable last week.
Yeah, Scott was really good. Those
shoes to follow for sure.
Yeah, it's been fun to do the show because, we've said this a few times, but kind of one of the founding principles was to have conversations we'd want to have anyway, but have them in public. And Scott Grossman from Turning Point Brands was great last week, and really happy to have you back on this week. We call it version 3.0. Does anyone know what version 1.0 and version 2.0 were? I'm going to ask you first, Sammy. Do you know?
The Spaces was 2.0.
Okay. Version 1.0. At one time, there was 3 of us, Sammy.
Oh, yeah. Toby. Yeah.
And there was version 2.0. We call it the consolidated version. And now version 3.0. Same group, obviously me and Morgan, along with guests. But for people that are listening to the podcast, or if you're listening live and wondering what's going on, we switched over to a new service, nerdy behind the scenes stuff. We're using something called StreamYard that allows us to go live on X, live on LinkedIn, and then we'll also get an MP3 or MP4, whatever it is, file, and we'll upload that to podcast platforms. So if you're a podcast listener, shouldn't see a lot of change. Hopefully the audio is better because Morgan and I are using microphones and Space's audio has gotten a little bit shaky. And if you like video, if you tune in live on X or LinkedIn, and I believe it's also going to save a recording live from the live recordings on X and LinkedIn. But still learning, again, first week, so we'll see how it goes. But excited for the changes. We do want to get to YouTube and start a Higher Exchanges YouTube channel, but we didn't want to make perfection the enemy of progress. So we figured we would take this step here, and then eventually we'll get over to YouTube and save the videos there as well. So that is the update on our side. Excited about the changes. And I think most people listening today, Sammy, probably know who you are, especially on X. He's a great follow. Just look up Sammy J on X. He shares a bunch of great stuff. But for people that might not know you, Sammy, who are you and what do you do at C21?
Well, I'm the VP of Corp Dev. Just like Scott, you've got back-to-back VP of Corp Devs on the show. So I'm with our chairman, Bruce McDonald. We tend to run all the M&A kind of corporate progress. I do a lot of. I wear multiple hats at the company, so I do a lot of news release writing, things like that. We're a small co, right? 20 million market cap, so. In the smaller companies, I think we have like 150 employees. You tend to wear more than one hat. So a lot of what I do is these days is focus on M&A. As you guys probably know, we announced a store last year that expansion that way, retail expansion. But for every thing that you do, you've chewed through hundreds. Gotten close to the finish line, dozen times, and it never had, especially in this space, right? I mean, we've seen it. We've seen some of the public ones, so we know, the Cresco and Columbia Care type stuff. So we know how these tend to progress, where both sides, for all intents and purposes, are earnest about the attempt, but there's so many things, there's so many hurdles and challenges in this industry to getting to a finish line. Obviously, the bigger you are, the more overlap you may have, and that obviously causes problems with the caps on licenses. But even for smaller guys like us trying to do tuck-in stuff, there's just so many challenges along the way. So, we were really excited to get that one across the board, and we're hoping that the ones following will be easier every time. For us, one of the big challenges for us was obviously we had a large senior debt that we were focused on paying off while the industry was kind of planting flags and chasing growth. So we kind of did things backwards. We paid off that 30 million senior note over 5 years with free cash flow. We've never issued any shares. We did a phenomenal job of really protecting the shareholder that way. And now we're kind of on, 2.0 growth offense. And so if you take a step back and look at the industry at large, for the most part, everybody chased the growth, around the all-time highs, whether they had a currency to kind of, do raises on the equity side, or once the equity really dried up quickly, everybody used the debt that was available. And for the most part, the industry over leveraged. And that's one of the main reasons why we find ourselves where we are today. So we kind of took the opposite.
You were one of the classic names, Sammy, that when we used to talk a lot about reform independent and reform dependent companies, you were one of the classic examples, one of those reform independent ones. And for a long while, those weren't the sexy names, right? Those are the ones trading at lower multiples. People were like, yeah, cool story, your balance sheet is good, but you've done it to be growth, and we want to focus on growth. But
Exactly.
I'm guessing that sentiment has turned around a little bit, and now kind of being boring and having some cash flow is the new sexy.
It is, except there's no investors left.
Right.
And so I'll give, when I used to field investor calls and, talk to institutional players in the space 3-4 years ago, you just summed it up, right? It was great job, guys. Great job paying, fixing your balance sheet. Where's the growth? This is a growth industry. And, for the years that I was on X putting up cash flow tables and kind of talking about this space is getting over leveraged, there's problems, and everybody was like, yeah, it's growth. Don't worry about it. And, the chickens have come home to roost, so to speak, right? So it was a challenge. I don't get those calls anymore. I don't get any complaints from investors, shareholders, though that the shift, I think, in the overall consensus on what this industry needs to do is very much that, right? I mean, clean up these balance sheets, kind of make sure you're self-sustaining, make sure you have cash flow, and, we'll find kind of sustainable growth moving forward. Obviously, intoxicating hemp has, eaten the proverbial lunch on, growth in this industry. So it's never been more apparent that everybody has to focus on, making sure the ship can float until we get to the other side. And the other side, of course, is regulatory, change. So, but we definitely did things the opposite, and it wasn't fun. A lot of battles over those years to kind of convince people that, we thought we were on the right track. And one of the things that's almost bittersweet is that we've kind of proved that it worked, right? We have the same shares out as we did 4 years ago, all-time highs. If you look at that table, I mean, we reduced our debt 90-something%, right? Nobody else has done that. Now that table is excluding 280E that I posted on X earlier today. And
you've done that without basically without having to do a recap, where, as you point, you haven't issued a ton of shares, or haven't had to issue any share. Are you, for everybody, are you guys, do you think of yourselves like an SSO? Are you just in Nevada, or what's kind of the footprint? Yeah.
We're an SSO, 100%. We still have some discontinued operations in Oregon from the 1.0 version of C21 from former management, but we're absolutely an SSO. Yeah. So, the SSOs tend to get the lower multiples. We understand that, but there's no price discovery. There's no rhyme or reason with what's going on in the markets. If you look at what we did, where we were before we announced that store, where our numbers were, where they are now, what we've shown in growth and improvements across the board. I mean, every single metric you can use has improved on this company. If you just look at, we were the first to put these 31s out, a couple weeks ago, because it's our Q3. We have a March 31st year end, so we were able to kind of turn that around quickly. But, top line's up, double digits in the last 6 months. That same store sales on that new store is 90%. Operating income's up 200+%. Cash flow's up 60%. I mean, you go across the board, this company's really humming right now. And we are lower now in the market without any dilution. So there's no kind of reason for it on that front than we were before we announced that store. We're lower now than we were before we announced those numbers. So, where's the price discovery? Where's the rhyme or reason in this industry? On a after 280E lens, we trade at the lowest free cash flow multiple in the publics. If some people are looking at two lenses, right? The free cash flow after tax, but before 280E, assuming Schedule 3 happens, I think we're somewhere around 3 times if 280E goes away. So it's there's companies in the space that trade at a higher sales multiple than we trade at free cash flow multiple. So nothing makes sense. And there's a lot of narratives about, well, it's only the companies that have a path to growth that are going to get the multiples, and you guys still don't have the path, but we just kind of proved that we do. That's a rinse and repeat model that we just showed, right? We can buy accretive growth, and then we can put our model into it and really make it hum and sing. And that's what we plan to do, right? We're not shy in what our focus is. We've made it clear. So, but I don't want to spend too much time on that because there's a lot to talk about how we got here as an industry at large.
Yes.
And how.
Yeah, so why don't we dive into that? I mean, I would love to ask you more questions, but you're right. Let's maybe I can come back to some of those at the end.
Yes.
But thanks for the rundown there. But yeah, I mean, was it just this past week we hit the 4-year mark of the Great Cannabis Drawdown? And measuring it by the industry's largest ETF, MSOS, over that time's down 93%. Top ticked, I think it was 55.91, Jesse, if that's right. And
Correct.
Yep.
today we're around,
What do we close?
trying to not look up too much, but 359 is what I see on my screen. So here we are 4 years later. I think, you've been putting some good data out around some of those contributing factors, but, from your lens, what's been standing out to you as far as some of these contributing factors? Is it a revenue issue, the deceleration of revenue to outright decline for some? Is it the margin? Is it the overspending that hasn't resulted in growth? To one of your charts, the amount of shares that have been issued to generate cash to try to go for growth, the amount of debt they've taken on to go for growth. Like, what's the Sammy J's rundown of how we got here?
Yeah, it's very much similar to how Scott framed it last week. He had the 4 buckets that he kind of called it, but nobody can really quantify the regulatory hurdles, right? The fails at progress for reform. How do we quantify what effect that had, what impact that had on these equities? It's hard to do, but it definitely had an impact, no question about it. I mean, we can look at the chart and see every time, safe didn't happen, drawdown, amplified drawdown. So if you look at the structural issues,
that could go into like the multiple compression bucket, right? So
yeah. And the structural issues that Scott laid out beautifully, right? Whether it's the kind of big board ETF that's extremely liquid, holding relatively illiquid underlying that trade on third-rate exchanges, right? It's that dynamic is very unique. There is no other industry that faces that. So it's a bit of the tail wagging the dog in that scenario. But there's many structural issues. I think the most important structural issue is custody, right? A lot of people say, well, we didn't have custody in 2021. Well, we had a heck of a lot more back then than we do now. Whether it was the compliance taps for large funds like Wasatch that got knocked out after all-time highs, JP Morgan and Credit Suisse and all the prime brokerage that basically closed up shop on U.S. cannabis after all-time highs. I was talking to an institutional investor a couple of weeks ago about the fact that they had to close their fund. It was a small kind of cannabis-focused fund, and he's still in the space on select names. But he was telling me he ran into one of the only prime brokerages that's still in the space, and he was kind of asking them, how many investors do you guys still have? And they told him they have one left. So one fund left in the space. And with Navy being gone, you just look across the board everywhere we look. Jesse, you had a great post about the analysts that have, whether they've been forced out or whether they've decided to move on. There's just nobody left except retail, and it's really unfortunate. And so.
Well, and as a result, I mean, the structural thing to your point is it's been just almost forced liquidation from institutional holders, even though they were always a small percentage ownership base. Like we've been a very inverted base.
That's right.
Compared to other sectors, right? Where usually it's 80+% is institutional. And it was never, I don't know if and Jesse might remember when you used to track this closer, but I think the highest we ever got as a sector was maybe 20% institutional.
Yeah, I don't recall seeing it that high, but I wasn't tracking it for that whole period. But it's been under 10% for the whole time that I've been tracking it. I haven't refreshed the numbers, but I'm guessing after Q4, that number gets down closer to 5%. And pardon my language, but I think maybe the really fucked up part here, Sam, is the fact that if you fix custody and you fix some of the plumbing issues now, the companies are so damaged by what's happened over the last few years. It's not like if you say, okay, now you can custody, I'm not going to pick on a certain name, but let's take a beat up name and say, now you can custody X, Y, and Z. I don't know there's going to be a line out the door to buy that at this point. So I think that's kind of what makes me sad, is that if we get reform, if we fix some of these reform, depending on what it is, can help some of the balance sheets. But the real kick in the nuts to me is the lack of plumbing, the inverted balance sheets, but now on top of that, the lack of growth. And Florida certainly was a contributor to that, but a lot of mature markets like you're seeing in Nevada. I used to cover CLS. You probably know Andrew and those guys pretty well. And Nevada's seen a ton of price compression along with almost every other market. And so I worry, Sam, and I don't want to steal from something further down the agenda, but it does bum me out that even if we fix some of the things that got us into the situation, like the plumbing, now I wonder if people are going to be standing in line to get to these companies.
That's why, whether it's chicken or egg, right? Whether the companies are at fault for why we got here, whether, they did the best they could with all, their hands tied behind their backs, essentially with, with no currencies to use and limited capital at such, egregious cost. We can pontificate and argue back and forth about whose fault it is. It doesn't really matter. This is where we are. And it's on these companies now to try to fix it with the tools that they have left remaining. And we all know this is no surprise to anybody. We have a massive debt cliff coming in 26. Is that going to be the reckoning? It remains to be seen, but a lot of these companies have matured, debt's maturing in the next 12 to 18 months. And if, I think, I want to say Viridian, somebody put out a note on this. I think it's about 3 billion that has to get refied, but they were saying, there's not going to be a lineup to do that. Right. So it's on these companies to get aggressive and try to, get in front of it and do it early. We saw GTI and TerraSend do that, and I think they did a really good job doing that. I don't think there was any equity kickers in either of their deals. So, at this point, it's a bit of biding time, right? Like, can you kick it out far enough that the reform comes? But, is it, whether it's safe banking, and I know, Morgan, I know those words hurt your ears, but, Schedule 3, obviously, I think we all agree is probably the most important thing right now. We need 280 to go away. I don't think people appreciate how much 280 impacts the cost of capital, and interest being non-deductible in this industry is killing these companies. right? Like most industries have debt, right? They carry debt, but you can't carry 13% debt that you can't expense, right? That's the problem. Even in a 50% gross margin, 25, percent, 25% EBITDA margin, like 20% operating income world, if 15% of it's going to just carrying the cost of your debt, right? There's nothing left for the shareholder. And
Totally.
we all know that's the best, like that's the GTI model. I think GTI's last operating income was 15%, 14 something.
Yeah.
And that's kind of where we are as well. That's not where the industry is, right? The industry is not generating that operating income. And so when you look at the debt and the dilution that's happened since all-time highs, where's the return on that, right? Where's the return on the invested capital? The calculation for ROIC, for people don't know, is net operating profit after tax. So where's the operating income? Everybody's is down from all-time highs, yet billions were spent. Billions were invested, CapEx, billions were invested on growth in new states. And between the margin compression, and maybe we just had the model wrong, right? Maybe we thought that the state level kind of step growth was the way, but maybe it's not the way. Maybe we need to find a way to get same store sales going. And what does that look like? Because right now, even if you have even if you have unit growth, as we're seeing in this industry, Jesse, we've talked about unit growth before, right? With the price compression, you're just not driving that revenue, and you're losing margin, and so obviously it's affecting the bottom line. So how do we drive same store sales growth? Well, the easiest solve right now is intoxicating hemp. However, this industry has no control over that, right? I mean, we're fighting a massive giant in that battle, and we can talk about this. Scott talked about it, the disunity in the industry, right? We're not working together to kind of fight these battles. So, taking on hemp, if we look at A3 in Florida and DeSantis and how hemp had a huge impact on how the outcome there in funding DeSantis in the kind of anti-A3 stance that he took. How does the industry win that battle? But I think we all agree that that's siphoning off the growth, right? That cannabis at large is growing we see that, right, in the United States, but state legal cannabis is stagnant.
Yep.
And so just a quick question on that though, is why do you see it as a battle versus trying to be a part of that growth?
It's a good question.
Because to your point about disunity, I mean, it's happening. Some others are starting to branch into it, and it's like, so they're realizing that you can either battle or join forces.
Off though, right, Morgan? Like you're seeing with GTI doing the, Agrify or Cura doing their own hemp line. You can't sell hemp products in your state legal cannabis stores.
Understood.
You can't in Nevada. You're not allowed to.
Right.
So are you going to open up a new wing of your business, new operations to kind of run that side of things? Are you going to have a standalone, hemp shop, smoke shop? Like, how do you make these things, come together? Yeah.
I understand. It's a fair question. And I think part of the problem of how we got here though, is what you said a few minutes ago, is the disunity. Yeah. It's not just between cannabis and hemp, it's within cannabis itself too. And this has been going on for years.
Yep.
There's been no regulatory progress, and a lot of the blame is on our industry ourselves because we don't know what we want. We're very confusing as an industry. And then hemp just comes strolling on in here while we're all fighting with each other about what we want to be when we grow up. And they just have steamrolled. And they're just continuing on. I mean, it seems
the unfair advantages that they have, where they're not paying for testing and they're not taxed, and
totally,
we can't match that, right? So it's and if you go back a couple of years, right, the leaders in this space were talking, oh well, safe doesn't matter, right? We don't need it. The small mom and pops need it. It's like we did need it. We need the custody for the equities, right? So,
but originally, safe didn't include custody.
No,
so a couple of years ago, it wouldn't have done anything. What's up?
You trigger the FinCEN updated guidance, right? I mean, we need the safe harbor. Ultimately,
Safer does now have it, but the original version did not. That was a big issue. That we were, and the problem, and again, this is the disunity thing, is we were trying to point that out, and people were, there was a lot of folks in the industry that said, well, we don't need it. We just need banking reform. And it's like, that's not banking reform though. So it's but again, that's part of the challenge.
Yep.
And I think that challenge still exists today. I mean, I'm still, I think this is a new regime, so who knows what could happen with President Trump, but we still have a very dysfunctional Congress that is still not on board in a broad, in a bipartisan way around safer banking.
I know.
And so, Sammy, we've had revenue decline, we've had margin erosion, we've had meaningful multiple compression, we've had intoxicating hemp stealing growth from the cannabis market. And so there's a whole bunch of reasons that we're 4 years into this and we're down about 95%, 95% from peak to trough on something like MSOS. How do we get out of this at this point? What are the catalysts that you can see that are going to cause our fate to meaningfully change?
We're really cheap. That's good.
But to your point, does anyone care? Is value is value a catalyst?
Nobody cares until they do, right? I mean, that's kind of what value is, right? Deep value investing is nobody cares, because if they cared, you wouldn't be cheap until there's kind of a trigger, right? Whatever that catalyst is going to be, and maybe we need multiple catalysts to kind of get a re-rate of the entire industry. Whether it's some regulatory catalysts, but we're also going to need some fundamental catalysts. I think we're going to need that, right? When you put up that chart the other day on the anniversary, the 4-year anniversary of the 93% kind of drawdown, it just dawned on me, I should take a look at what the multiple compression was, right? And so I within an hour, I had put up a similar post to you, but I took it from that lens of, where were these stocks trading at all-time highs and where are they now? And, we talk a lot in this industry about kind of 25 times EBITDA, but this sector wasn't trading at 25 times EBITDA. It was trading at like 75 times EBITDA. What it was trading at on the 25 times was on this forward, estimate that that was so far from anything that was reality that, yes, I know the markets are forward facing, so that's what it was pricing off of. But the reality is, at the time, in 21 at the top, the average was kind of 15 times sales and about 75 times EBITDA. And now we're at 5 times EBITDA. And that,
just real quick, you said 15, we topped at 15 times sales?
Correct.
Oh my gosh.
15 times kind of TTM sales and 75 times TTM EBITDA.
What was the growth rate back then? Do you remember when we topped it? Were we still like?
Yeah, it was still high double digits at the time, right?
But
but it was projected out that, a lot of these names were going to double again.
Right.
And you think of some of the, and some of the managements are to blame, right? There was some very aggressive guidance from some teams, and some of the analysts are to blame with just not doing the work on this. But if you look at that chart that I have on my X, you'll see kind of that it goes 75 to 25. It's like we're like in 2 years it was gonna, we were supposed to double again as an industry, and it's just like, where's this coming from? So, and I don't think we saw hemp coming, right? I don't think the operators saw hemp coming. I don't think the operators saw the oversupply and the compression coming. So, but regardless, we're trading up 5 times, right? As an industry now, five times EBITDA. So it was like 93% as well, the multiple compression. So you could almost say that the entire drawdown is completely correlated with multiple compression. I know Scott talked about multiple compression last week, but I didn't appreciate that the entire drawdown matches the multiple compression from reality, not from what the estimates were, but from what these companies were trading at in terms of, at the time, sales and EBITDA. So
in that context, then the market actually is an effective pricing mechanism, because it was.
I had this eye-opening moment when I saw that. I was like, geez, what does that mean? So now we have to ask ourselves, why is the market pricing us here? Is it because they believe that this entire sector is on its way out, except for maybe some select names that can survive this? Is it that they don't see a path to any growth or any turnaround? Or is it just simply because all the capital left? So this is where you're going to hang out for now.
Well, yeah, I mean, it seems like to me, I've sat in a similar seat to you, Sammy, when I was an analyst talking to investors. It might be
Yes.
Leaf Brands still talking to investors. And at the risk of stating the obvious, you have a washed out group of retail investors that have doubled down 5 or 6 times. And even, most of them are either tapped out. Yeah, I mean, you look at it from big funds that have left, and some of the big funds that left, just to be clear, they had redemptions and were forced out, right? Like it wasn't they made, and so, I don't know about every case, but it wasn't as if they made necessarily a strategic decision and said, "I'd love to sell my stocks now and get out of this." The investors said, "I've had enough of this," and sometimes those redemptions come at year end, depending on your liquidity structure, and so that's why some of the funds are out. It's all driven by the same thing that drives analysts leaving, right? It's a lack of investor interest.
That's right.
And so you have the group of washed out retail investors, which are a lot of our friends, that we talk to on X and LinkedIn. You have limited institutional involvement, and so it's very limited. And so it seems like, Sammy, all that's happening is people are trading around dollars between stocks. Maybe I'll sell my Air and I'll buy some C21. Maybe I'll sell some of my cannabis and buy some Leaf. And I think you've talked about this, Sammy, on days when MSOS isn't trading, the volumes are just abysmally low. And that shows like the actual participation in these names. So going back to this about valuation being a catalyst, but going back to this about is valuation a catalyst? I think that you said it well. You said it well before. I don't remember exactly the phrase you used, but something like you're going to need multiple catalysts, and value is a catalyst if maybe paired with something else that brings in fresh investors that are looking at these stocks.
Yeah, I mean, we can't just have SAFE or S3 happen and then what? Like we're going to see these companies report year ends. We already know, it's flat. In some cases, maybe worse than that, but there's no growth right now. And I was screaming this for years, guys. Like when everybody was pointing at New Jersey as the best thing to happen since sliced bread, and when everybody was talking about Connecticut and Ohio, and I was saying that like all of these new states coming online are just filling a hole in the back of the boat. Mm-hmm. And it came to fruition. Like it's exactly what happened, right? So we need some sort of fundamental catalyst for the industry. You had floated the idea of like, is there something that we're not seeing that could come and sneak up? Like let's hypothetically say that something like a Constellation came in and did their $4 billion investment into a GTI or something like that right now. Is that going to spark interest into this industry? I don't know. I don't think it's going to be
a great return for GTI shareholders, because that would be a 3x almost from here.
Yeah, but I don't know if it's going to be what we saw in 2018 as far as just the euphoria around that entry from major CPG into cannabis, because it didn't work out. It turned out horribly, right? I mean, that $4 billion is gone and there's nothing to show for it. Yeah. So, I think if we get SAFE, some argue that SAFE in itself is a boost to sales if Visa and MasterCard and the credit cards kind of feels like it's now safe, because as we all know, if you have $50 in your pocket and, that's all you can spend. But if you have your credit card in your pocket, you might spend a bit more, right? And we're all like that in spending. So, there's probably a boost in top line just on that. But, on S3, obviously it's a huge impact on cash flows. However, a lot of these companies are already realizing that in, taking their 280 and putting it as an uncertain tax position, right? So they're already there. What we're seeing them report now is already their cash flows X 280E. Now, whether or not you are on the side that there's a reasonable basis for taking that stance or not, I don't know if we want to have that conversation or that argument, but let's just assume that we all feel good about that move. to an uncertain tax position because there's a reasonable chance that these companies are going to be winning that battle, and we don't know when that battle is even going to come up, right? Like, it's probably going to be a court battle, maybe the Boys case, right? The Supreme Court case, or the hopes that it becomes a Supreme Court case, and that decides. And is there going to be anything retroactive, right? I mean, you think about someone like GTI, like, it's different for the other guys, the other big names, that if there was something retroactive where that big uncertain tax position goes away. For a GTI, that's a $500 million kind of check coming back to them, right? Because they paid it. So there's, tremendous variance. I think there's a tremendous variance in how 280E is going to impact the basket, right? Someone like us, we're 6 times free cash flow with 280E. We're 3 times without it. Like, it's dramatic for us. But we're still paying.
And you're retail heavy, Sammy, right?
We're retail heavy, and we're still paying, as much as we can. Kind of, I think we paid kind of almost $1 million in, probably accrued about the exact same amount in the last 12 months. So we're kind of paying about half. We're trying to keep up with it as best as we can. But, we're also trying to grow now. So we don't want to put all our cash generation to just, dealing with that tax. So, and now that those companies have taken that kind of more aggressive stance, I think a lot of and every conversation I have with people, I've asked Scott this. I don't know if it was privately or publicly, but I asked Scott, like, because Scott's on the road, like, he's in shops all over the nation. He's talking to privates all the time. And I said, are they, how are they treating 280E? And they're, for the most part, nobody's paying. And a lot have refiled. A lot of the privates have refiled. A lot of them stopped paying. A lot of them aren't even booking it. And so this is not the top 5 to 10 names are in big trouble with the IRS. This is a industry-wide issue, right? Like, this is across the board. There's only a few names that are paying their taxes, right? So, like, for the most part, an entire industry, a $30 billion industry, has said, we're done with this. And now we're waiting, we've served, now we're waiting for the response in some way, right? Like, how is this going to play out? What we do know, at least from precedent with the State House case, is that, if we can get some sort of payment plan that's, favorable, like they got, that's probably a great win for a lot of these companies, right? It was, it was over a long period of time. It was a very manageable monthly kind of payment, and I think we would all take that right now.
It's cheap debt, but they are the most senior secured.
Yes, but
you can get.
They're not likely to do to you what happened with State House's creditor, right? Which is that they took over the company.
Well, they had to.
So,
yeah,
I mean,
and Morgan, let's just pause there, because you said something to me. Like, this was like a couple of years ago about the equity being dead in some of these companies, and that didn't fully resonate with me back then. Like, I understood conceptually, but I think that's a really important point about where, let's talk about the credit, what the the cap table looks like. The IRS is going to be on the top, right? And then you're going to have, the various debt portions. Then at the bottom, you're going to have the equity portions.
Right.
So you look at some of these companies that have $500 million, $400 million enterprise values, and some of them literally have 15, 20, 25, $30 million in equity. I mean, I looked, and our company, Leaf Brands, I think we have a larger market cap than some names like the cannabis and things like that. And so I think it's important for equity investors to understand, like, does this company persist in some way? Maybe, but some of these names probably end up being, owned by the creditors, maybe not the IRS in a lot of cases, but the creditors are going to take control of a lot of these, and the equity is going to be a zero.
I think Boris recently called them all zombies. Yeah. It's really unfortunate. Right. I like a lot of the people in this industry. I talk to a lot of these companies. I feel like there's good people. I feel like everybody is trying to do their best for the most part with what, the hand that's been dealt. So I don't want anybody to go away or to have the creditors kind of, take over. But reality is, likely that in many of these cases. Now, at the same time, if we got, Trump comes out tomorrow and says, I'm doing everything that I promised before the election, all of it, And well, we know what's going to happen, right? Those that are tied to reform as the lifeline are likely going to rally the most. And those that are kind of self-sustaining probably won't. Whether that's right or wrong, it doesn't really matter. That's likely how the market reacts to it. I mean, we saw it with A3 as well. A3 was kind of priced in on the Florida names. We saw tremendous rallies in the Florida names, and I posted the 3 months from election day, which was maybe a week or so ago. I posted the 3-month returns, and obviously all the Florida focused names are down the most. Those that weren't tethered to that are performing much better since the election, right? So it's that being said, if you get some sort of dramatic reform, can these companies find a way? Now, one of the things Bruce always says to me is that equity and credit are, equity and debt are interchangeable. So in some ways, you can look at the debt that's on these companies as what's the market right now, and if you had to convert all of that debt to equity, what does that look like? Right. Do complete equitization of the debt. What does it look like? Right. Now, I'm not saying that these companies have that opportunity. I don't think there was anybody, but we kind of saw it in some ways with Vireo, right? With Chicago Atlantic, where a creditor is kind of saying, okay, we're going to equitize this and we're going to move forward, and we're going to actually not just take over, but we're going to kind of, do something that can kind of transform the company and hopefully protect the equity investor as much as they can. It remains to be seen how that plays out, obviously, because that deal's not even closed, I don't think. But, on one hand, they transform from like a tier 3 to like a tier 2 with 400 million in top line. And, they obviously jumped up, to a different level. On the other hand, I think they have 1.2 billion shares out consolidated on that deal. And 763 million of them are M&A shares to vendors that were privates that probably don't have any cost basis or very low cost basis. And in this market, I mean, we've seen it with the M&A heavy companies that came to market. I think of a Verano or something like that, and how hard it is to absorb all that vendor paper in this market. We just don't have the liquidity for it. So I don't know what the solution is for those, over levered companies. If there's a way to get from where they are now to a healthier place. We were in there were people saying that we were dead 5 years ago. And not only did we pay off that debt, we didn't issue a share to do it. And so, I know we're small. A lot of people say, well, you're just a single state operator. It's easier for you. But in some ways it's harder because a huge percentage of our top line goes to just being a pubco, right? Like the percentage of a 30+ million revenue run rate is it's like 10% of us is just pubco, being a pubco. Totally. For a larger name, that's not the case at all. So there's pros and cons, obviously, of being bigger and smaller. Obviously, there's no economies of scale in this industry. It's diseconomies of scale, right? You have to have, that state silo model. We could talk about it interstate and how that's going to play for, the glass houses of the world. I mean, if we look at Glass House is one of the best performers. Leaf, right? It's one of the best performers for a reason. I think there's been a shift in what this, the investors that are left in this industry, what they think the future looks like.
Yeah. I mean, I think anyone thinking interstate commerce is a reality in the near term, I just don't see it at all. I don't see it at all. Because we can't even get states working. Why would they want flooding in of out of state? I mean, it's just like so classic to the prohibition analogies. I think it's going to be a very fragmented patchwork, and probably when interstate is really robust, we'll be far beyond our times in this space. But it is a good question though about, when we do emerge from this bear market and we move back into a bull market,
yep.
Who are the companies that could be, the leaders out? Because, typical bear market cycles, it's the former leaders are not, the leaders again, right? And so like in the last, I mean, I might be overdating myself here, but is it going to be the Canopies and the Tilrays, or is it going to be U.S. operators? Is it, and kind of part of that thinking though is to your point of like, how much are these reform dependent names when we actually do get a move? How much will they actually move before they are actively and aggressively equitizing their debt to clean up their balance sheet? And so the share issuance goes out demonstrably and dilutes the ability for the enterprise value to really expand because they're just exchanging their debt for equity. So what do you think about that as far as like what kinds of companies for our audience here, like what would you be thinking about that, the kind of qualities of companies that you'd want to be thinking about that could be the leaders out of this?
I mean, I haven't changed my opinion on this for years. I've been very vocal about, what I'm invested in the space, and self-sustaining cash flows is, it was, whether it's boring or not, whether it's, a slower path to the growth that people want to see in this industry. It's just, I sleep well at night because I know that they're not going away tomorrow. And I don't see anybody rivaling GTI right now in terms of the lead that they have over everybody else on the pub. It's hard to know with the privates, right? We just don't have the visibility with a lot of them. But on the public side, nobody is close to GTI right now.
For sure. And to your point about privates, I mean, they're saving $3 million or so a year, not paying listing fees.
Right.
I do think that is an area that could be a known improvement for our space, though, is, we are heading into a less regulatory regime, and that could include capital markets expenses. So even if that goes down by, 30%, I mean, that's a meaningful difference for you.
Yeah, but a lot of them are, the cost of the insurance, right? D&O insurance is insane. So
we've been paying for D&O for 11 years. I mean, it's insane Morgan, how much money we've spent.
That comes down through Trump's kind of deregulation of the United States, or does that come down when we get safe harbor and safe banking and insurance, federal insurance companies enter cannabis, right? So I still think that we need that massive regulatory, step. And then there's going to be a ripple effect on all these smaller things that are, can have huge improvements on these companies, right? Things that nobody thinks about, D&O insurance, right?
Hey Sammy, dumb question. Is it more expensive to be listed on the NASDAQ than like than OTC? Like if we were uplisted, how would that change for the public companies?
Yeah, no, it's much more expensive.
Okay. Yeah. So in an uplisting environment, that portion goes up. Hopefully it's a value-added fee in that case, but that would increase. So how are you talking, Morgan, about potentially those costs coming down?
I mean, just the costs of being compliant, the filing fees and audits and everything is a big cost.
And when you only have a few auditors that are even touch the space, they can kind of charge what they want.
It's similar to D&O. It's not a competitive market, so they are just taking absurd amounts. So I do agree. I mean, there's some of those fixed costs that will improve. D&O, I mean, that's been brutal. There was a point where we did have a more robust market, but to your point, as soon as the clampdown that echoed through the custody chain, and it was the D&O chain, because there was a time when there was almost too many insurance companies trying to bid without knowing what they were doing, and they wrote a lot of bad policies and got crushed. And so they all just freaked out and blamed the industry and not their own bad process. So, because we're getting into insurance renewal season. So, these conversations are very ripe in my head for sure.
Right. For sure.
And so, Sammy, typically on a bear market bottom, the stuff that went down the most goes up the most.
Right.
And that's kind of a different way of saying that, like, junk tends to bounce most off of the bottom. When I hear you talking and just knowing you a little bit, I think of you as more of an investor than a trader type mindset.
Right.
So when I hear you saying that if we were to get something like an S3 or a safer that leads to a bounce, you're saying I still like the same, what we'll call higher quality, less levered, cash flowing names. But is that a different statement than you saying you think those bounce more off of the bottom? Like, is there a chance that let's say we were to,
Well, I think the over leveraged names bounce the most off the bottom.
Okay.
We've seen time and time again from any pseudo catalyst that we've had on the regulatory reform. That's just the way this space is. It's a mean, there's a bit of a mean reversion in those scenarios, obviously. But if you're in a death spiral trade right now that we're seeing in some of these names, right? And you get that lifeline, the likelihood is that you're going to, rebound the most. And look, there's a lot of traders in our echo chamber, right, on X. So that's what a lot of the focus is how to time these events and how to kind of, capture the biggest returns off of those things. I'm not in it. Morgan's not in it for that. I'm not in it for that, right? We're not trying to capture, the 1X off of the bottom on the announcement of SAFE, right? Like we're trying to pick companies that are generating value, companies that are building their value. And to do that, you have to, deliver returns, right? Like it's, I was talking to you guys about this offline, right? Like if we're small, so everything's relative, but we spent $3.5 million in 24 on that new store. And if you take a look at what it's done to our numbers, top line, margins, operating income, cash flow, the measurable return on invested capital there is one of the few examples that I can find in the industry where, a company went out, did M&A and delivered the results off of it. And a lot of what happened in 21, a lot of that, what that chart shows, right? A lot of that debt and dilution there was some major M&A, right? Like there was a lot of big deals that happened. But even though top line in a lot of those cases went up dramatically, what we saw is that some of these names were actually cash flow positive and they lost their models along, they blew up their cash flow models. Some of these names, their margins got tortured by those deals. Some of their balance sheets got absolutely wrecked by those deals. So it's measure 10 times, cut once at this point. I think it's one of the reasons why we're not seeing the consolidation and that I think we all anticipated last year and like the year before, right? Is when is it coming? Like there's a lot of cheap opportunities here. Why are the GTIs of the world not, taking advantage of the market? It's they're only going to buy something that's going to be accretive to their bottom line, and they are damn cheap. So it's going to be hard for them to find something accretive.
What I see too, Sammy, is that everyone's holding on to their good assets, and the assets that are for sale are generally lower quality assets, and people aren't doing cash deals for those. So who wants to trade shares for lower quality assets at this point? I think that's part of why it's so hard to get stuff done as well.
And there's so many assets for sale. Like it's just the list is insane right now. So
and this kind of ties into the challenge of the bounce back of these, you're saying like the most reform dependent bounce back the most, but also thinking about your chart of how much shares they issued or how much debt they've taken on. If you think about just taking a hypothetical, a company back at its prior peak, if it's issued X of call it 100% more shares to get back to that prior peak is twice as big of a market cap. So why would it? I mean, I understand that animal spirits don't really tend to care about that, but I mean, like you look at, I think Tilray's issued like 90% dilution. So for it to ever get back to a meaningful price it just becomes such a big valuation. So
I hate naming peers, right? Like because I talk to a lot of these companies, so I'm not going to get in the let's pick on names. But there's a name in there that doubled its share count just to kick its debt out for a couple of years, right? Like that's what we're doing.
Might as well just say it rhymes with bear, right?
I'm going to pick another one that you may not figure out.
Okay.
2021 at all-time highs. In 2021 at all-time highs, I think they were valued at about 2 billion Canadian. They had, since then, they've issued 135 million shares. They burned 115 million in cash. They expanded to 3 states. They've added 30 stores. It was 29. I think it's 30 now. And they have less top line than they did when they were a single state operator in 2021. Think about that for a second. 135 million shares, 115 million in cash burned. Three new states, 30 new stores, less revenue, and like 80% less EBITDA than 2021 when they were single state. So when we talk about like when people are,
it sounds like we're playing Name That Tune.
When people are trying to figure that one out, but when people are screaming, MSOs is at fault for why these stocks are here, right? It's it's the market makers, it's the shorts. It's like, yes, shorts have obviously taken advantage of the weakness in these names, but there's an example of value destruction, and there's no way to look at it other than that. It's absolute value destruction. Whether it's dilution, whether it's cash burn, whether it's over leveraging your balance sheet, whether it's, expansion that went wrong, there's been a lot of self-inflicted wounds, and I think we have to face reality before we can move forward. We have to stare in the mirror here and say, what did we do wrong as an industry? What do we have to do differently moving forward? Assuming we all survive, or a good amount of us survive, what can we do? What should we do differently? What did I think everybody should stare in the mirror and say, what did GTI do different than what we did? Why are they in such better health than us? And yes, they're not, their growth is single digit right now. And so it's not exciting, but they're so well positioned for when this industry turns the corner, from when capital comes back, for them to kind of, get back to being a high growth company with a clean balance sheet and with, operations that haven't really given back much of their value at all, right? They've really held firm. And we've got to ask ourselves why. What have they done differently? We absolutely model. We're little, we're single state, we're small, but we model ourselves off GTI. We always look at how they do things, and we try to, use them as the model for what we want to achieve. So, because there's really nobody else that's done what they've done. So hats off to Ben for that, and the team there.
So there's an MMA coach, I think his name is John Kavanagh, who wrote a book called "We Win or We Learn." And I don't know if he made that up or if that's a well-known phrase, but pretty basic concept there, that if bad things happen, you make mistakes, it's okay. If you don't win, then you better learn from them.
That's right.
So in that spirit, Sammy, looking back over the last 4 years, what's the biggest lesson learned? What's the biggest takeaway for you?
The chasing top line growth is the quickest way to blow up your company. It's what retail, I understand it's what retail investors and, what investors scream for, but it's the quickest way to shoot yourself in the foot. I think a lot of companies announced their growth initiatives along the way of the last 5-6 years as being accretive. And I don't think 99% of them were, because they're not actually measuring the right things. If you are trading at, maybe back then they were trading at 5 times sales and they bought something for two or 3 times sales, and they're like, this is an accretive deal. That's not what accretive is, right? Like you need to generate profit. And if you buy something, I'll give you an example. A company's trading 1-time sales, $100 million market cap, $100 million of revenue, trades 1-time sales. Let's say they're doing 10 million in cash flow. If they're going to take on 100 million of new capital, if they do equity, they have to buy something that's generating at least 100 million in sales and 10 million in cash flow, right? For it to be neutral. Ideally, they're buying something that has more than 100 million in revenue, more than 10 million in cash flow, for it to be accretive. In debt, on the debt side of things, they need to buy something that has at least 100 million in revenue. But now you need, because the average cost of capital in the industry, all in cost, is kind of 15, 16, 17% right now. Like I'm talking about once you add OID and the fees and all this stuff, right? What's the real cost of the capital? So let's just call it 15%. for most of these names. Obviously, GTI can get a better deal than that, but that 100 million of revenue now has to generate 25 million of cash flow for it to be a neutral deal if you take on debt. And as we all know, this industry took on $3.5 billion of debt from the top to today. I'm talking, when I say the industry, I'm talking about the underlyings in MSOS, right? I measure everything off of that. So the 20 names took on $3.5 billion of debt. In order for that to have at least been a neutral move, they needed to generate about $500 million in additional operating profit to carry the cost of that debt. And as we know, everybody's operating income is flat at best. Most names are down. So that's the reality of what went wrong with this industry. It was the leverage, and I don't think anybody appreciated what taking on that kind of leverage in a 280E non-deductible world, what it really meant to their bottom line. And that's the unfortunate truth. So knowing that now, I think everybody recognizes now what went wrong. For those that can find a way to solve that, I think you're going to have a lot more measured, decision making moving forward on that front. And look, if we become a normalized industry where we're, Schedule 3 or descheduled or something like that, and the cost of capital is similar to other CPG industries, obviously carrying debt on your balance sheet is going to be fine. We see that across, maybe not to the extent of some companies, right? Like the super over leveraged CPG companies tend to trade at low multiples as well. But, when your cost of capital is sub 5%, it's okay to have that on your balance sheet. When your cost of capital is 15% and you can't expense it, now you got a problem. So that, to me, that was the biggest mistake the industry made. That's the biggest learning lesson, is that I think growth was measured on the wrong lens for the industry. And look at GTI. What have they done in the last 4 or 5 years on the M&A side?
Not much.
Not much. Why?
So,
because they look at everything. That company looks at everything from that lens. They will not bite on something if it's not actually accretive to the bottom line.
I can't tell you how many conversations I've been in where people are like, "Oh, GTI is talking to us." I'm like, because they talk to everybody. They do their homework. They canvass this space inside and out.
Absolutely.
And they are relentless. And so they have a really good stand. So one thing though that I think GTI has also done a good job of though is, their brands, right? I mean, everybody knows dog walkers, and I saw like Joe Rogan, like there was picture. So, but from your perspective, like what is a product that you're most proud of, or you think that you guys have that's like a standout, that's a that you're think is really
Nevada's
a favorite with your customers?
Yeah, Nevada's a really interesting market, Morgan. Nobody has really made a lot of inroads on having their brands kind of capture statewide. You've got 101 dispensaries. About half are owned by the pubcos, and most are fully vertical, and everybody's very protective of that, right? In that state, with the margin, it's a mature state, and with the margin compression and stuff, if you don't have that vertically integrated margin, you're not going to make it. We've seen a lot of think of someone like Flower One, who tried to be the big cultivator in the space, and how that turned out, right? So everybody's very protective of selling their own in-house products in their stores. And yeah, you can sell at other people's stores, but you're not going to get, the bud tenders aren't going to promote your products, and you're not going to get, the shelf space and stuff like that, right? So for Nevada, I don't see. I mean, GTI, of course, is in Nevada. They're the biggest operator in Nevada for a reason, right? It's a very profitable state. But it's not like anywhere you go in Nevada, it's dog walkers is the most, is the only, it's not that at all, right? In our stores, we offer GTI's products, but our in-house products are what fly off our shelves, right? Now, is that because we can price ours, we can be a price leader on our own in-house? That's usually the case, right?
Sure.
You offer everybody, but you tend to be price leader on your own in-house products. Like our Phantom Farms, which is legacy brand from Oregon that we brought to Nevada years ago. That's our in-house flower brand, and we sell it at other dispensaries. But it's wholesale is a mugs game in Nevada, right? I'll give you an example. I think Nevada's at the state average right now, about $900 a pound on the wholesale level. So even if you're a super efficient grower like we are, say you can grow at 500 pound for indoor, 500 a pound. The cultivation tax in Nevada is so egregious that there's just, you're talking about 10 to 15, maybe 20% of margin left. It just destroys your consolidated margin. So everybody, you do a bit of it if you've got excess inventory and stuff like that, or if you're growing more than you need, but no one is in that market to kind of, to be a Cresco per se, where you're really trying to, take control of the wholesale market there. There are some privates that do really well with, but they're the privates that do well in other markets as well. The Robes of the world, the Stizzies, things like that. Right. So, but it's just a very unique market that way. It's very retail centric, let's call it. Like, GTI, I think, has 11 stores now. They're over 10% of the stores in the state, and we're 5% market share, but we only have 3% of the stores because our stores are exceptional and kind of do way above the state average. Our true legacy stores do as much as one of the tier 1's 5 stores in top line. So,
and how not created equal.
It's not created easy. I get that pushback all the time. Somebody said that when we put our numbers out. The one negative was, but you only have 3 stores in Nevada. Like, but it's not about that. We did $1.5 million of free cash flow in the quarter. That's what it's about, right? So do the math on that when you're $20 million market cap. Like that, we're delivering real returns for our shareholders that way, right? And we announced a buyback, and we're finding every way we can to kind of build the value of the company. We're going to try to rinse and repeat what we proved that we are really good at. We're an exceptional operator in that state. We're going to stick with what works for us. We're not allergic to the idea that if some great opportunity came up to merge with somebody in another state or something like that, I feel I spend most of my time on the phone, whether it's with other companies, whether it's with analysts, bankers, whoever in the space. I mean, that's what you do when you're in a role like I am, and or doing modeling kind of potential M&A, sensitivity analysis, things like that. But like I said at the beginning of this, for every one that you're successful with in this industry, like you said about GTI, right? You talk to everybody. You start down the path with a dozen, and you get to the 20-yard line with maybe 3 or 4, and you get to the 5-yard line with 1 or 2, and then you don't, in some cases you don't even get there. And that's just the nature of how difficult it is in this industry to consolidate.
That sounds like some of my friends' dating strategy in college.
That's awesome.
Well, this has been great, Sammy. One thing I just want to say thank you and appreciate is, I was in the role of an analyst before, and part of my job there was, contributing a lot to the community and sharing research. Now transitioning to my new role, my allegiance is first and foremost, doing things for Leaf Brands, but also trying to do, things like this and make some other posts that add some value. And I think you do as well as anyone in terms of, Scott as well, Morgan as well, in terms of people with full-time jobs in the industry that don't get paid to post on X, and it's a pretty selfless thing to do. So just want to say thank you for your can't speak, Jesse. Thank you for your continued contributions in that regard. Doing shows like this, we're at a time where there's a lack of, sincere.
I'm doing the work, and you see, I'm doing the work. I read everything. I know every company inside and out. It's just who I am. I'm just a sponge for data and information and numbers and knowledge. And I just, everything, anytime that I have an aha moment, where I think like that one with the 93% multiple contraction, I'm going to share it, right? So that's what I do. And for the most part, our X community, right, is, it tends to be geared to retail investors in the space that are left in the space. And I want them to make good decisions, right? And it doesn't mean they have to invest in C21. We might be too small for a lot of people, and or not exciting enough or whatever. Like, it's not about that. It's about, understanding what you're investing in. There's going to be a lot of people that try to continue to time the trade of this industry on the regulatory front. It's just always been the case. If you look at the history back to when Morgan started, right, every bull run in this industry was driven by regulatory change, right? Whether it was California, Canada, like the Blue Senate, every time, even on the smaller micro pops, like the Nancy Mace bill, right? Wouldn't we all dream about another 100% pop like that one in 6 days? We little C21
fear it now because they're just afraid of it, how quickly it comes back down. You know what I mean? I think it's like everyone wants the durable, not the pop, because kudos to those that have been able to trade that effectively. And I know they all pat themselves on their back publicly on X when they do, but I'm much more in the
sure
position.
Will.
What's that?
Said some sure will, right?
Oh yeah. They only talk about their winners. They never talk about the L's.
Yeah,
for sure. But yeah.
But no, I never.
I
made the mistake of taking a small bet on A3 because I was like, I felt the FOMO. I felt like I was going to miss out, and it was, and I blew up on that one. Big mistake. I shouldn't have done it. I know better. I hadn't done it to this point at all. I stuck to my guns about just investing in sustainable, cash generators, but I was like, I feel like if this happens, it's going to be a game changer. I better have a bet on this. And as we all know, that was not a bet to make. So lesson learned on that one. But
yeah, I think you're in good company there. I think there weren't a lot of folks. I think that I didn't see really anyone that was bearish on A3 at the time. Even the most respected people
it's what you talked about earlier, right? A lot of repositioning happens with the money that the capital that's in the space. I think Tim Seymour said it to me at Benzinga 2 years ago. He's like, there's no new dollars coming to the space. And that was 2 years ago. Right? There's no new dollars. It's just repositioning, right? It's like, let's all bet on GTI and C21 or whoever, is the cash generator because times are tough, or let's all bet on the Florida names because there's a catalyst coming, or and it's just like, shells get moving the shells around. But ultimately, there hasn't been any new dollars, and if anything, there's been money leaving, considerable money leaving the industry, and it's unfortunate. It's up to these companies to dig themselves out. We're going to see where everybody stands in 2 weeks. GTI is the 26th or 24th. I can't remember. Less than 2 weeks, and then everybody follows them like usual. And we'll see where everybody stands. The best advice I can give is to do your homework. Make sure you're investing in a name that doesn't need reform to get from here to whenever that day is going to come. And hopefully they're building value for their shareholders that may not be reflected yet in the stock price or the equity, but that's actually happening, right? And so that when the day comes where people start looking at the space again and they say, oh, look at this company, they're, so then that's the best that you can hope for right now. It's not exciting. I feel like I do these and I have this bearish tone, but I'm not bearish on the industry. I think cannabis is here to stay. We're seeing the impact that it's having on alcohol, right? I mean, the transformation, especially younger generations. I'm seeing it in my own, personal experience, where a lot of people aren't drinking anymore. They've moved to something that remains to be seen. What level of health benefits there are as we open up research, but we all, I think, feel like it's a much healthier choice. And we're gonna see how it's all gonna play out. It's hard to say we're in the early innings anymore, because we were saying that 6 years ago, but in a lot of ways we haven't moved. So we're still kind of in the early innings. We need normalization. We need, we were talking about earlier, what's going to bring same-store sales growth? I mean, normalization is going to bring same-store sales growth. When the mom or dad that right now still thinks it's taboo goes in and buys the Incredibles or whatever because they want some help sleeping at night, that's what's going to bring the same-store sales growth, right? And that's going to get unlocked as we get reform. So
yeah, the way I've been thinking about it more is we have this destination over here that we all see, and I think that is I don't think a lot has changed in terms of where we can ultimately end up, but I think the timeline and the path to get there is the thing that will speak for myself, and I think a lot of us have been wrong about. And I've been saying lately there's a fine line between being early and being wrong, and I think we're walking that. Maybe we've crossed over, more to the wrong side than the early side. So I agree with you, Sammy. I think ultimately we get to that place of normalization, but what does that path look like? And unfortunately, what's caused me to take a much more realistic, I don't think I'm embarrassed or pessimistic, but I think it's just a realistic tone,
yes.
which I hear the same thing with you,
yeah.
is how much damage has been done along the way. And that's what's kind of been bumming me out lately. It's like, okay, even if we get the catalyst, we get the reform now, how many of these businesses are so damaged, not just because of the reform, but because of other decisions made along the way, like you talked about the overspending on growth being a big one. When that time comes, 280E removal isn't going to save those businesses the way it might have, 2 years ago, for example.
Yeah, I mean, it's fun and sad to kind of think of, had we gotten the reform 2-3 years ago, how would this have all played out? Would we be in a similar place? Would we, what would the landscape look like? Because those companies were making those mistakes. Had we gotten the reform and they had more access to capital, they would probably continue to make those same mistakes. So, would we be in a similar place? I don't know. I mean, maybe the equities would be in a better place, but I don't know if the health of the companies would be any different. I think, the loophole in the Farm Bill is really one of the, it's hard to measure what impact it had on this industry, but, we're starting to really see, with every examination of what the impact is, I'm really starting to believe that hemp is the real. And to your point, Morgan, it doesn't mean it's a us versus them. We have to be enemies. Like, is there a solution where these come together under one regulatory framework? That's, it's actually likely that could be how it plays out. But there has to be a level playing field. State legal cannabis cannot win this battle under the current, framework, where they don't have to, be under the same heavy regulations and not taxed and all the things that we have to face. So ultimately, some sort of leveling of that playing field. And, there's a lot of politics, obviously, that's going to be involved in that, because there's a lot of, conservative states that are very pro-hemp. And, those senators tend to, if we think like a Kentucky or something like that, they're going to be very favorable to the hemp side of this equation. Yeah. So we don't know.
What Missouri did was a really good example, though, of like a forward-looking thing where it's all going to go under cannabis except for beverage, which is going to get carved out. And, if any of our listeners, I mean, I've been professing that for how many months now, that's where this is going to land. And because it just makes sense. There's age gating, there's plenty of control, there's a distribution channel. It's just resolving the licensure and testing requirements of what's going into those things, but that will get resolved. And but the states are, so it's just interesting. I mean, maybe a question for you
though, right, Morgan?
What's up?
It's the enforcement as well, though, right?
Oh, for sure.
How do you enforce it?
Enforcement's been a big issue since the whole idea of legal cannabis.
Yeah.
Like here in California, we banned hemp altogether, right? Intoxicating hemp. And there's been zero enforcement. Has it gone away? Nope. It still exists everywhere. It's just not enforced. So it's like, it's even way worse. Like what California did was absolutely, and no surprise to anybody, completely moronic. And
yeah.
So,
but I mean, I talked to some Vegas operators from time to time, and they've been telling me the impacts of hemp are being really felt there. as well as the illicit market is still kind of, it's amazing how much of an impact it's still having in a place like Las Vegas, right?
I mean,
But
it's maddening because you pay all this money to be an illegal operator and you get nothing from the state to support you.
You get nothing, no representation at all.
You get worse than nothing because you pay all these fees and you have even more competition as a result.
There was a recent article, right, about Vegas specifically and how, the state legal operators aren't allowed to service the strip. They weren't allowed to, and it's like, but the hemp operators are.
Everywhere.
Yeah, and the hemp operator stores are full of California products. So
and you go in the back room and they're full of California products, right? So
it's cannabis too. It's not even, they just call it hemp.
Actually cannabis, and it's it's much cheaper. So you look at a state like Nevada that peaked at 1.1 billion or over 1 billion in 21. It's down to the last headset monthly run rate was 51 or 52 million for January.
So that's 40%.
Yeah, no, it's just incredible, right?
Yeah.
And there's the state is now saying they're going to get aggressive on trying to figure out a solution for this, because they're, that's one of the states that really uses that tax revenue, right? And they've lost a lot of it, so they want it back. So we'll see what they
think about a plan aggressively.
But to your point about interstate, your earlier point about interstate, right? Like these states aren't about to give away this cash cow, right? They built these state, models that they're not going to want to go away anytime soon. So there's going to be a lot of pushback on that whenever that day does come. And to your point, we can't get anything passed, so I'm not worried about full legalization tomorrow. Let's just get something. And rescheduling is the thing that it's absurd. I mean, I just posted today the non-toxic versus highly toxic list of drugs. You guys know this. I'm not teaching you anything. Cannabis being the least toxic and heroin being the most. And it's a cool chart because it's where every drug is scheduled, and there's just no rhyme or reason at all, right? Alcohol being one of the most toxic is descheduled, and it's like, so when are we going to get the politics to, when are we going to get the politicians to finally stop with the politics and recognize what's happened here?
When we get our shit together and start working together and as an industry, and including hemp, like we've got to be very clear about what it is that this industry wants, and not having diverting messages in DC and having different representations that are arguing for different things. That's why I say it's some of our own worst or our own fault for this, as we are just not clear about what it is that we need, and we have very few dollars, so our representation as a result is very much smaller. So we got to come together, and we've got to, all these trade groups, all of these CEOs that, thinking single representation in DC is a good use of dollars. It's not. We've got to be working together, and it's got to stop. It's got to change, because it's just another year is going to go by and we're going to be talking about the same shit. I can promise you that.
How does
After 11 years of this,
state legal cannabis convince hemp to kind of come under the same tent? I don't think they're in any rush to be highly regulated, right? So how do you convince them to come together and have the same message moving forward in DC? Yeah,
I mean, I think we got to have a real get together with the stakeholders and talk this out and come to a solution, because these conversations are not being had, and it has to, so that there is a realistic way forward here. And it's not going to be great for everybody, but it's going to be great for the greater good. And that's what's got to happen. I mean, I'm getting tired of this, because, after 11 years of watching the fragmentation and arguing, and it's like, we all just keep arguing about it, and we gotta be a part of the change. And that's just, we've got to come together and figure it out. And, hemp is not going away. There's a lot of bad actors in it though. And the real people in hemp know that there's a lot of bad actors, and they're afraid of that, because they don't want it to get ruined for everybody. Right. And so I think those are the groups that you want to work with, or that we want to work with as an industry, and say like, okay, let's solve this issue and figure out what are the key points that we need to be getting clear on, and figure it out. And that's why I point to Missouri as like, beverage does seem like a great place to just like let that exist.
Oh,
And then
yeah.
if it's intoxicating, there's a regulated channel for that that's got, great control over age access in the legal licensed stores. And let the consumer choose. Let the consumer choose.
100%. The carve out for beverages is it's complete common sense that's the approach we should take. But I hear your frustration. I hear your frustration about stakeholders in the industry and the fragmentation of everybody's agenda. And unfortunately, I don't know how we fix it. I hear you, and I agree with you that it needs to be fixed, because otherwise we're not going to have much of an industry left. So something needs to change, something needs to happen. And maybe at a Benzinga type conference where we have all these stakeholders in one place, someone needs to get up there and have this conversation. Honest, maybe the two of you are perfect for that.
That's a good idea. I mean, Chicago's coming up. I'm sure the Elliot and those guys. What's up?
Yeah, it's going to be in June this year. It's going to be early.
Yeah, just one big Benzinga this year rather than two.
So maybe that's the place. Talk to Elliot and the crew there, and
everybody. Yeah.
See if they'll give us that segment to kind of preach this message, because part of the problem right now, we heard some of the tier 1 CEOs say, they've come together for the greater good, stop the infighting, stop the egos, and are working together now.
That was a good step. USCC and NCR coming together. That's a step. And so we need more of that
kind of momentum to continue, right?
Yep.
Yeah.
Well, why don't we wrap it here for today, lads? I have another meeting coming up here in a few minutes. So unfortunately, got to get back to the day job. But great conversation today, Sammy. I really appreciate it.
Thanks for having me, guys. I appreciate it.
I know, Morgan, you've got an Ask Rock. You want to fire that off?
Sure. So, kind of the magic 8 ball of this entire conversation was, I said, "Dear Grok Lord, when will the cannabis bear market end?" Thanks to Jesse for this idea. And Grok says, "It's tough to predict the exact timing of when the cannabis bear market will end, as it depends on several factors. Regulatory reform, major reforms such as safe banking or full federal legalization could improve investor sentiment and access to capital, profitability. Companies that can show consistent revenue growth, positive cash flow, and operational efficiencies are more likely to lead a recovery. Macro conditions, broader market conditions such as interest rates and economic outlook play a role in investor appetite for riskier sectors like cannabis. Mergers and consolidation, the industry may need more M&A activity to remove excess capacity and reduce competition. And consumer demand, continued demand and increased legalization in new markets, states or international, could also help reverse negative trends."
Sounds fair.
Yeah.
Agreed.
C21's checking those boxes.
Well, good stuff today, guys. Good conversation. Sammy, thanks again for joining us. If people don't know you and they want to follow you, where's the best way to track down a guy like Sam Armenia?
On X. If not, give me a shout at my email address is so complicated. I will. I could post it.
Okay. And are you on LinkedIn? I tried to tag you once on LinkedIn.
I'm not.
Okay.
There was a reason historically why I wasn't, and I haven't been lazy to get my profile going since I used to be.
Okay.
Pre-cannabis.
Okay, I got you. Yeah, I just looked to tag you in a post the other day, and I couldn't pull you up. So no worries on that. But yeah, good stuff. Sammy J is a great follow on X. So if you don't follow him, definitely check him out there. We're going to be off next week. Morgan and I are both on the road next week. So Higher Exchanges will be taking a 1-week hiatus. Then we will be back on the 27th, and we have a really exciting guest, a new voice for everyone lined up for that show. So super excited about that.
Cool.
So thanks, Morgan. Thanks, Sammy. Thank you all for listening, and we'll see you guys in 2 weeks.
Cheers.